Hey, Chris here. In this video, I want to talk to you about 5 things that I learned by reading the book Investing for Growth by Terry Smith. If you're someone that's looking to make a lot of money investing in the stock market for the long term, I think you'll really want to hear out these 5 tips that I've got for you in this video. By the way, before we get into it, this book and this very book behind me here, The Intelligent Investor, were actually given to me as a gift by Honey, the completely free stock market newsletter, which has been set up by Free Trade. If you want to get signed up to that newsletter, I'll leave a link in the description. And if you sign up to it through my link, they'll send me even more books on investing. So of course, I'll read those and make videos about those as well. Now, I can really comfortably tell you these tips here on this video because they are from the man himself, Terry Smith, who's been nicknamed the English Warren Buffett. If you can ever be compared to someone as fantastic as Warren Buffett, then you've obviously done something right in your investing lifetime. Tip number 1, as it teaches you in the book, is to only buy good companies. Now, that might seem really obvious, but you'll be really surprised, or maybe you won't be surprised, at how many people just buy companies because they think that the price is going to go up, or they might buy a stock, which, remember, at the end of the day, buying a stock is you're owning part of that company. They might buy it because it's one of their favorite products. Well, if you're just buying it because you think the price is going up, that's called speculating, that's not investing. And if you're just buying it because you use the product and you haven't even checked any of the company's financials, that's also a recipe for disaster because, yeah, you might really like the product, but if the price isn't going to go up in the long term, you're not going to make any money. Tip number 2 is to pay a fair price or favorable price. And that's because if you have a fantastic company that's growing really well, but the value of its share price is just way over the top, because remember, at the end of the day, you can have a great company, but the price just might be ridiculously expensive. Well, if you pay over the top for a stock and then something happens and that price comes crashing down and people are selling out of it, that's really not going to put you in a good standing for making good profits in the long term. Yes, you may recover that money in the long term. So say you buy a company that's trading at $300 a share and they have a bit of bad news, so it knocks them down to $250 a share. Yes, say over 3 years it could then recover, but it's much better off, of course, to buy into a company when it's, say, gone through some recent bad news, which isn't, that bad news hasn't really affected its actual business. It's just a temporary glitch in their share price. A great example I have of that is this week the share price of Facebook actually dropped quite dramatically, and that was just simply because a whistleblower was reporting them for doing some things that she didn't think were quite right.
Her name is Frances Haugen. That is a fact that Facebook has been anxious to know since last month, when an anonymous former employee filed complaints with federal law enforcement.
But that has had no effect on their actual business. That's just caused some people to panic sell out of it. And since I bought into it, the price has already started to climb back up again. Tip number 3 is to not panic or get excited at any short-term price movements. So if you buy into a stock and you see that the price is, going up one week, going down the next week, and you're letting your emotions take hold of you and that is bothering you, then that's not investing for the long term. You want to, if you've bought the great company and you've paid a good price for it, what happens to its price, month in, month out, really should not affect how you feel about that company. Tip number 4 is to really research a company and check its financials before you press that buy button and commit yourself to investing in a business. So a great example of that is before I really got into investing and was reading books about it and had any clue what I was doing, I invested £1,000, so roughly around $1,300 at today's exchange rate, in a company called SPI Energy. And that was literally because they mentioned that they had plans to build an electric car. And I was so naive, I had no idea what I was doing. I thought, oh, that sounds great. I'll put money into that. Hopefully that'll go up. Then I realized when I, later on in my investing lifetime, realized that, okay, that company is actually making a loss each year. They'd done the same thing with cryptocurrency by saying they were going to create their own crypto, and then that obviously never happened. So that is why this tip is very crucial. Really, really do your own research before you press that buy button. Tip number 5 then is to literally do nothing. And that sounds really weird, doesn't it? You would think in order to make a lot of money in the stock market, you need to be buying and selling and getting really excited, and that's how it's portrayed in the movies. But actually, if you've bought the great company, you've paid a fair price for it, and you have done your research on it, doing nothing means that you just allow that company to then commit its business and earn money and then reinvest it. And any dividends, so maybe the only thing you need to do is any dividends that it pays you, just buy more shares in that company whenever you get paid those dividends. Dividends obviously being a share of the company's profits to their investors. And funnily enough, on the back of Terry Smith's book, you will see there when it focuses, they buy good companies, don't overpay, and do nothing. That's their 3 main things that they really focus on when investing. And you can't argue that it doesn't work. They have averaged over 18% per annum since their equity fund was founded in 2010. That really weird noise that you've been hearing is actually my dog licking himself, so please just ignore that. And if you've had any value from this video, please do press the like button. And until next time, thank you so much for watching, and I'll see you in the next one.